Today, we're going to talk to Dean Fergie from Cyan Investment Management. Dean specialises in the small cap sector, including IPOs. So we're going to ask him how he goes about selecting IPOs that are good and avoiding the duds. Dean, welcome back. You're in lockdown because you came up to Sydney. We're on the 1st of July, the beginning of the financial year. You've obviously in lockdown got plenty of time to have thought about the past 365 days and how it's worked, in particular because you look at the small cap end of things. Can we start off looking at the IPOs that have gone on for the past 12 months or that have come to market in the last 12 months?
Yeah, I mean, a really topical question, Chris. The market's been extremely active, as active as I can remember in the primary new issue market. There seem to have been deals every other week, and I guess with more deals, there's been more dispersions in outcomes. That it's obviously always with these things, it's buyer beware, and IPOs never have a track record, or you don't have a lot of time to really get to know the businesses. So you tend to fly a little bit blind in that respect. There've clearly been some really, really good ones. Business like Trajan invested the other day, and is trading a good premium. Airtasker is up more than 100% on its IPO price. And then there've been very, very big cohort of disasters. We saw a high profile one, Adore Beauty, which is trading well underwater, and probably the most high profile one is Nuix, which I think is down about 60 or 70%. That was one of the largest, most hyped up high profiles IPOs of the last 12 months. So as in any year, there's lots of winners and some very, very big losers.
So how do you avoid the losers? I mean, the way we look at things, avoiding potholes and pitfalls is the best way to actually protect capital. But how do you go about that? I mean, you have all access to the numbers, you have access to the presentations and the pre-IPO pitches. What's your trick for avoiding them?
Look, I mean, there's never really a trick that means if you implement these aspects that you'll never get one wrong. We've got a number of wrong and a number of right as well. I think for us, it's not getting sucked into the excitement and hype of a certain sector that might happen to be flavour of the month. Nuix is probably a topical example. I wouldn't say we're necessarily smart about that. We may have been lucky, but we looked at that business. We saw a number of red flags for us, which would apply to any IPO. That is a big sell down by founders, management that don't have big stakes in the business, very rich valuation on very, very modest profit numbers and revenues that were, I wouldn't say optimistic, but were high growth revenue numbers. So when we see those red flags, that really for us makes us quite reluctant to put money into a business like that. We like putting money into IPOs where they're investing, they're using that money for growth or to make an acquisition, not for someone to exit. So that's sort of one that we were lucky or smart to avoid because of our conservative nature.
I think we give you the benefit of the doubt and say that it's smart, so well done. But I think it's probably easier for you because you're able to pore over these things and you're an expert with lots of experience in that. It's much more difficult for the average investor or the private client who is being pitched by a broking firm, and I don't want to single out any broking firm, but the broking firm or the underwriter is there to try and get this away. So that makes it a really good reason to invest in a fund other than taking your own sort of punt if you're a private investor. But what proportion of your assets are now in IPOs that listed, say, in the last 12 months?
We've probably got about 4 out of 25 positions in the market. So what's that kind of, 15, 20%, something like that, just in terms of numbers. Look, it does change a lot. We've had much larger proportions over time, certainly IPO businesses that have done extremely well, and then we've decided to liquidate or otherwise. What I would say with respect to individuals investing in IPOs versus funds is that we're in a fortunate position that we get to see a lot of them, and it's much easier to select one or two that you like when you've been shown 20 or 30 versus selecting one or two from 5 that a broker is showing you. That's one advantage is the breadth of offering, and you can compare a lot more businesses to one another and decide which ones you like. And secondly, being the professional market, you do have an insight as to how well they're going. We speak to a lot of brokers around town. We speak to a lot of other fund managers. Certainly in Melbourne, I think the market's very collegiate down here. And so you have a sense also for the demand for them, for the hype, which is, not a super technical aspect, but it is important as to how these things list, on the first, days or months. And once a business has a bit of momentum, that tends to carry through, certainly until they get, some decent results on the board. So they're two advantages, I think, that we have that potentially private investors don't always have.
Yeah, I think that's very true. Dean, looking at the rest of the portfolio and looking at the current environment, let's look at the rest of the portfolio first. Have you seen much sort of change in direction or movement in the portfolio over the past 12 months as the initial sell down when COVID first hit? And obviously we had this amazing rebound over the past 12 to 14 months. Has that changed what's in the portfolio for you or the way you approach it?
Not really. We've had a few businesses that have probably disappointed over the last year that we've sold out of. And then again, we've had some others that performed very well that have become larger parts of the portfolio that, arguably we've also had to sell down a little bit just to manage the weightings. What's been tricky over the last 12 months is the volatility in the market. We have had businesses that have performed, from a share price perspective, much better than we could have ever expected. And we're not really even sure why. Like, we don't sort of always confuse that with being smart. We've maybe been a little bit lucky in some respects. Other businesses have fallen a lot further than we would have expected. Certainly in the last month, I think there's a bit of tax loss selling that's come into some of these micro caps, which I don't think have really reflected the underlying performance of those businesses. So, what's been hard is I think that the change in sentiment in the market, there's been a lot of volatility driven by day traders and other sort of investors that don't always focus on the fundamentals, and the swings in share prices from month to month basis has been made it reasonably hard to manage, albeit, over a long term, over the 12 months, our results have been, slightly better than the overall market. So it's a good result, but it's been a very, very bumpy road to get to the destination this financial year.
Small caps and mid caps have done much better than the underlying market over the past 12 months. That's not always the case, but it's been an incredibly strong 12 months, really. I think we've had one negative month in the last 12. So do you just put that down to the fact that small caps do better in rising markets than the bigger end of the market?
I think that's one aspect of it. I mean, I do think that, small caps are clearly riskier. They just don't have the integrity of their balance sheets and corporate governance and all those other things. But probably what I put it down to is the fact that you've got a large cohort of new investors now that are day trading or short-term trading the market, and they're not looking at making a quick buck out of NAB or Wesfarmers or these other big, less volatile stocks. They're looking, down the curve. Everyone's on a lot of investor forums, and you've seen, the likes of Stockhead and Livewire and these news sites that are chasing the next big thing. Like, everyone wants to be on the next Afterpay or Zip Money or any of these, hot stocks. And I think that's where a lot of investors are putting their focus, and where they're driving a lot of the short-term gains and volume in these small to micro cap stocks. It's made that end of the market very, very, very active.
It certainly shows through in our data where we look at, if we just look at small to mid cap managers, the average small to mid cap manager over the past 12 months has outperformed the ASX200 Accumulation Index by 10%. So 38% to 28%. Now 28%, gee, that's pretty good. This is to the end of May. But in fact, that's the same, because we've been in this strong market, that's true over all time periods going back sort of 5-6 years. So that's certainly a happy hunting ground, and reinforces that argument from a lot of small mid-cap managers that there is more opportunity outside the top 100 large stocks or 200 large stocks in the other 2,000 odd stocks to find little gems. Is that still your sort of feeling for it?
Yeah, it is. Look, I think what's happening from a structural perspective is that in order to produce excess return, one has really got to find information that is not broadly known by the market. And with the advent, which has been a factor for 10 years or more now of online trading, the fact that reports have got to be released to the market, that you've got the internet and PDFs can fly around almost instantaneously, that it's harder to find information that's new and fresh that everyone else doesn't know about it. And so what it means is investors are having to move down the curve from the large businesses that have got very strong governance rules in terms of distributing information, to the smaller ones that are maybe a little bit looser with all that sort of stuff, and you have more of an opportunity to read between the lines and find out exactly what's going on. And so that seems to be a continual race, almost a race down the curve, in order to be able to find businesses that are offering something that other investors maybe don't know, and which will provide a bit of alpha for people investing in them.
Well, you've certainly benefited from that over the past year. You've outperformed the ASX200 over that 12 months to May. We don't have June figures obviously as yet. And since inception, the numbers I'm looking at are 15.4% since inception versus the ASX of 8%. So, that's pretty close to double the ASX return. So it sort of proves that you've been able to do that consistently over time. Just turning to the COVID impact, where we're now back in lockdown certainly in Sydney. Melbourne's just coming out of lockdown. It's been a long time since Sydney and Melbourne have ever done anything in lockstep. So there's certainly no change on that. It's our turn now, and hopefully you won't get your turn again. But how do you see the threat or the opportunity as sort of the economy gets tossed around by lockdown and restrictions and the tourism market we were talking about earlier? Do you change? How nimble do you have to be, or do you just keep your stock selections based on the fact that you're very selective to start with?
Look, I think what we've seen is the biggest structural COVID shock has come and gone, and that was coming up on 18 months ago, where this is all very new. No one knew how it was unfold and how the economy would react and how governments would react and the like. And what we've seen, we've kind of bounced through that. And so whilst all these shocks are difficult from a personal perspective, economically, I think the market's proven that they just look through it, that both here and internationally, we'll go into a environment where most people are vaccinated, where the world's open up, and whilst there might be short-term shocks, that there'll be tempered a little bit by government spending, if anything else. So that's what I've seen, is that the markets tend to look through these things, and so to be really, reactive, to be going, Sydney and Queensland are going to lockdown, let's go and buy some Kogan and Temple and Webster shares. Oh, okay, now it's all opening up, let's go and buy some Webjet and Flight Centre. I think it's really kind of really reactive, and I don't think that's a sensible way to make long-term returns. I think you've got to stick with your knitting, find out those businesses that are going to be structurally impacted over the long term, and maybe lighten off on those, work out ones that are going to see a little bit more opportunity, and you're not going to get everything right every day, but if you see yourself through the cycle positioned well, that should mean you come out the other side in good shape.
Dean, I think you've proven you've been able to do that over the years. I'm sure you'll be able to do it going forward. Good luck with the rest of your 14-day lockdown, having been up to Sydney. That's the danger of coming up to Sydney, of course, is, you never know what's going to happen when you get back.
No, it was worth every day of it, Chris.
Look after yourself, stay safe, and we'll look forward to speaking soon. Many thanks for your time.
You too. Thanks for having me on, mate. Cheers.
Okay, cheerio.